Good evening, everyone, and welcome back to Advanced Accounting. Tonight's class, we're going to be focusing on Chapter 10, topic of foreign currency transactions. Now, a lot of this stuff we'll see in this chapter is going to relate to that of the derivatives module, so you'll see some similarities between the two once we get moving through this content. Remember that Chapter 9 and the derivatives module's homework is due tonight at 11:55 p.m. I'm actually going to be posting the answers to Chapter 9 and the derivative module's homework once I get out of this class. I apologize for that. I actually left the material that I needed to go over that back at the house, so I do apologize for that, but I will make sure that I get that posted so that everyone has a chance to see the answers before they need to submit the assignment. So just be on the lookout for that. And also, in regards to homework for Chapter 10, I have not picked out what I want everyone to do yet. My plans were to get them in before the start of the class, but I had to do midterms today, so I do apologize about that, and I will have that posted by tomorrow by early afternoon for Chapter 10 homework, and it'll be about the same amount of work that we've seen in the past for the past chapters. Nothing major, just enough to touch up on the topics practice the topics that we've covered in Chapter 10. So with that being said, let's go ahead and get started on Chapter 10. And once again, this is on foreign currency transactions. So what are our learning objectives for this chapter? We're going to explain the floating international monetary system and identify factors that influence rates of exchange between currencies. We're going to define the various terms associated with exchange rates, including spot rates, forward rates, premiums, and discounts. Account for a foreign currency transaction, including the measurement of exchange gain or loss. Identify the context in which a company may be exposed to foreign currency exchange risk. And understand the characteristics of derivatives and the common types used to hedge foreign currency exchange rate risk. And explain the accounting treatment given various types of foreign currency hedges. So the international monetary system. So prior to 1944, the gold system provided a strict system based on gold. The currencies of nations were backed by or equivalent to some physical measure of gold. So a nation's supply of gold, therefore, ultimately influenced the money supply, rates of exchange, prices, and international trading levels. Now, in 1944, the Bretton Woods Agreement, which created the International Monetary Fund, known as the IMF, and a fixed-rate exchange system, was signed. The fixed-rate system required each nation to set apart a par value for its currency in terms of gold or the U.S. dollar. In turn, the U.S. dollar's value was defined in terms of gold. Now, the IMF could provide support to a nation in order to maintain its par value. Changes in a currency's par value was referred to as devaluations and revaluations. Now, as pressures to maintain the par values established by the fixed rate system increased, pressure was placed on the U.S. dollar. So in 1971, the U.S. government, for all practical purposes, terminated the Bretton Woods Agreement by suspending the convertibility of the dollar into gold. Now, currencies temporarily became part of a floating system where rates of exchange were in response to the supply and demand factors affecting a currency. Shortly thereafter, the IMF accepted the Smithsonian Agreement, and this Smithsonian Agreement actually devaluated the U.S. dollar and did not allow for the convertibility of the dollar into gold. So the Smithsonian Agreement was short-lived. And in response to the increasing pressures on the U.S. dollar, the fixed-rate system was abandoned in 1973. So today, the international monetary system is a floating system whereby the factors of supply and demand primarily define currency exchange rates. Each nation's central bank may intervene in order to move its currency toward a target rate of exchange. Supply and demand factors, along with possible central bank intervention, result in much more uncertainty and risk than experienced in a fixed rate system. So a number of factors beyond supply and demand affect exchange rates, including but not limited to a nation's trade balances, money supply, economic stability, interest rates, and governmental intervention. So the mechanics of exchange rates. An exchange rate is a measure of how much one currency may be exchanged for another. These rates may be in the form of either direct or indirect quotes made by a foreign currency trader who is usually employed by a large commercial bank. So these large commercial banks are the ones making these quotes. A direct quote measures how much of the domestic currency must be exchanged to receive 1 unit of the foreign currency. And we will refer to the foreign currency as FC. So indirect quotes, also known as European terms, measures how many units of a foreign currency will be received for 1 unit of the domestic currency. So if we can see here on the mechanics of exchange rates, the exchange rate quotes, the direct, we're going to see one foreign currency is going to be equal to that of 25 cents of the dollar. The indirect quote is going to be $1 equals 4 foreign currencies. So as you can see here, they're just complete opposite. One's direct and one's indirect. So this is just complete opposite. 25 cents is the value of 1 foreign currency. So $1 is going to equal 4 foreign currencies. So the strengthening currency would be evidenced by a reduction in the directly quoted amount and an increase in the indirectly quoted amount. Okay, exchange rates often are quoted in terms of a buying rate and a selling rate. So the buying rate is known as the bid price and the selling rate is known as the offered price. The buying and selling rates represent what the currency broker is willing to pay to acquire or sell a currency. Now, exchange rates fall into 2 primary groups. A spot rate is the current rate of exchange between 2 currencies, and forward rates apply to the exchange of different currencies at a future point in time. An agreement to exchange currencies at a specified price with delivery at a specified future point in time is a forward contract. Although future exchange dates typically are quoted in 30-day intervals, contracts can be written to cover any number of days. So to illustrate a forward contract, assume a forward rate to buy 1 foreign currency to be delivered in 90 days is at $1.65. This means that after the specified time from the inception of the contract date, 90 days, 1 foreign currency will be exchanged for $1.65, regardless of what the spot rate is at that time. So as we can see here, at the inception of the forward contract, the forward rate is going to be 1 foreign currency is going to be equal to 1.650. So in 90 days, the settlement of the contract, the exchange rate is going to be 1 foreign currency equal to that of 1.650, regardless of what the spot rate is on that day. Several aspects of spot rates and forward rates are noteworthy. First, typically both rates are constantly changing. Spot rates are revised daily as they change. Forward rates for the remaining time covered by a given forward contract also change, even though the forward rate at inception is fixed. The value of forward contract changes over the forward period. And secondly, the ultimate value of the forward contract must be assessed by comparing the original fixed forward rate against the spot rate at the settlement date. So in the above example, at the settlement date, the holder of the contract will pay the fixed rate of one foreign currency at equals 1.650 to buy a foreign currency rather than the spot rate of one foreign currency equals 1.655. As we can see here, the current spot rate when at the settlement of the contract is 1.655 as opposed to what the exchange rate is at one foreign currency at 1.650, which is what the forward rate was at the inception of the contract. Finally, the difference between the original forward rate and the spot rate at inception of the contract is 1.650.164. We can see that right here. So the difference is in the spot rates. Now, the difference between the spot rate at the settlement of the contract and that of the spot rate at the inception of the contract is going to represent a premium or discount, which is traceable to a number of factors. This difference between the spot and an original fixed forward rate represents the time value of the forward contract. If the original fixed forward rate is greater than the spot rate at inception of the contract is said to be a premium. And the opposite situation results in a discount. So in this case right here, we're looking at a premium here. And what determines whether it is a premium or a discount, once again? If the original fixed forward rate is greater, so the original fixed forward rate, right here, 1.650, is greater than the spot rate at inception. So the spot rate is 1.640, so we see that it's greater, so this means it's going to be a premium. So if this forward rate was actually less than the spot rate, it'd be a discount. So that's important to know there. So if the original fixed forward rate is greater than the spot rate at inception, then the contract is said to be a premium. We've already established that. So at inception, the difference between the forward and spot rates represents a contract expense or a contract income to the purchaser of the forward contract. So the forward rate for a currency can also be derived by the following formula. So let's look here. So in order to find out what the forward rate is going to be on a contract, which was this one right here, the forward rate. So to be able to get that, the formula right here is as follows. We have the direct spot rate at the beginning of the period, and then we multiply that by the ratio of 1 plus the interest rate for domestic investment during the period over the 1 plus the interest rate for the foreign country investment during the period, and that'll equal the forward rate. A good example, if this formula does not make sense, or if you're having trouble looking at this and trying to figure it out, if you refer to page 551 of your text in chapter 10, at the bottom of the page, it's got a great example here of how this formula is applied, and actually applies it with numbers. So if you're having trouble just deciphering what this formula really means, then just take a look at page 551 at the bottom of the page, and it's self-explanatory by the example that's given there. So no one should have any trouble after looking at that. And if you do, please contact me so we can go over it and make sure that you do understand it. So if the interest yield on the foreign currency is greater than the yield on the US dollar, the forward rate will be less than the spot rate, and the contract sells at a discount. And the forward contract will sell at a premium if the opposite is true. So as previously mentioned, changes in exchange rates represent an additional business risk when transactions are denominated in a foreign currency. The accounting for foreign currency transactions measures this risk and demonstrates the use of both spot and forward rates. So accounting for foreign currency transactions. So changes in exchange rates do not affect transactions that are both denominated and measured in the reporting entity's currency. If a transaction is denominated in a foreign currency and measured in the reporting entity's currency, then changes in the exchange rate between the transaction date and settlement date are going to result in a gain or a loss to the reporting entity. So what about some effects on rate changes? So if there's no exchanges, gains or losses, then transactions are denominated and measured in the reporting entity's currency. So if there is exchange gain or loss, then the transactions are denominated in the foreign currency and measured in the reporting entity's currency. So the FASB adopted the two transactions method, which views the initial foreign currency transaction as one transaction. The effect of any subsequent changes in the exchange rates and the resulting exchange gain or loss are viewed as a second transaction. So if we take a look at the slide here, it says transactions are denominated in foreign currency and measured in dollars. Domestic currency, changes in exchange rates between the transaction date and the settlement date expose the domestic company to exchange gains or losses. And if a foreign currency transaction is unsettled at the end of the period, exchange gains or losses should be accrued. So unsettled foreign currency transactions. As we just mentioned, if a foreign currency transaction is unsettled at year end, an unrealized gain or loss should be recognized to reflect the change in the exchange rate occurring between the transaction date and the end of the reporting period. So therefore, at any given time, the asset or liability arising from a foreign currency transaction that is denominated in a foreign currency should be measured at its fair value as suggested by current spot rates. The changes in fair value, both positive and negative, are recognized in current earnings. In essence, the asset or liability is marked to market. So just like trading securities and stuff of that sort is marked to market at the end of the reporting periods, such as these foreign currency transactions that are unsettled at the end of the reporting period. They're marked to market. So to illustrate the accounting for unsettled transactions, let's assume a U.S. company purchases goods from a foreign company on November 1, 2015. The purchase in the amount of 1,000 foreign currencies is to be paid for on February 1, 2016 in foreign currency. To record or measure the transaction, the domestic company would make the following entries, assuming an exchange rate of one foreign currency equals 50 cents. So if we can see here, once again, the transaction involves the purchase of 1,000 foreign currencies. So at point A, that's the transaction date. The spot rate is one foreign currency equals 50 cents. So if we look at the next slide here, see what the journal entry would be. Number A right here, or letter A. Inventory would be debited for $500. Accounts payable credited for $500 as well. So this case, purchase inventory at the rate of 0.5. Remember, it's 1,000 units at 50 cents a unit, so that's where we get the 500 here. So what about at point B at the year end? So at this point, the spot rate is that one foreign currency equals 0.52, so 52 cents. Let's go back down and look at the journal entry. So for B, the exchange loss would be 20 because we're incurring a loss here, and the accounts payable would be increased by $20 because at fiscal year end the rate is 52 cents per unit or per foreign currency as opposed to 50 cents. So the reason why we incurred an exchange loss here and increased accounts payable is because now the exchange rate is more expensive than it is different at 52 cents as opposed to 50 cents. So the 20 comes from the spread between the 52 and the 50 here. At 2 cents times 1,000 will give us the 20. Because now it's going to be a loss because now we have to pay more in order to purchase those foreign currencies as opposed to we did before. So now on C, the settlement date, the spot rate at this time is one foreign currency is at 55 cents. So once again, at this point, that's the settlement date. So now we're going to debit accounts payable for $520. $520 because from A, accounts payable was $500, and we incurred the loss in B and increased accounts payable to $20. So the $520 gives us $520. So we'll debit accounts payable for $520. Then we have to also incur the additional exchange loss of $30 from where the spot rate changed from 0.52 to 0.55 from that of the fiscal year end up until the settlement date. So we incur that additional exchange loss of $30, and then we pay the cash of $550 to settle the accounts payable and also incur the other exchange loss of $30. So the exposure to foreign currency exchange risk and the use of derivatives. So companies may be exposed to foreign currency exchange risk in several situations, including the following. An actual existing foreign currency transaction that results in the recognition of assets or liabilities. So as previously illustrated, the risk to be hedged against is the risk that the exchange rates may change between the transaction date and the settlement date. Another situation is a firm commitment to enter into a foreign currency transaction. So beginning at the date of the commitment, the risk to be hedged against is the risk that the value of the commitment, which is fixed in a foreign currency amount, could be adversely affected by subsequent changes in the exchange rates. Another situation could be a forecasted foreign currency transaction that has a high probability of occurrence. So in this case, the risk being hedged against is the risk associated with exchange rate changes. And another situation is an investment in a foreign subsidiary. Translating the financial statements of a foreign subsidiary expressed in a foreign currency into the domestic currency of the investor entity can affect the equity of the investor entity. The risk being hedged against is the risk that the translation will reduce the investor's equity due to adverse changes in exchange rates. So the last one we went over, an investment in a foreign subsidiary. We're actually going to be discussing that in chapter 11. So that is not of any relevance in this chapter. I just want to go ahead and make mention of it prior to getting to that chapter. So it's a little foresight of what's coming in the next chapter, but the first three are relevant to this chapter. So we see a little timeline here as opposed to these different situations. The first would be the company forecasts the transaction, then the company will commit to the transaction will occur, and then payment is made on the transaction. So what are some characteristics of some derivatives? So this is the part of the lesson right here that should seem really familiar and have a lot of overlapping material from that of the derivatives module. So this should sound pretty familiar to, or similar or familiar to a lot of you all. So the characteristics of a derivative, as stated, a company can be exposed to the risk associated with changes in currency exchange rates in a number of contexts. So common strategies to hedge against such risk involve the use of derivative financial instruments. So a derivative is a type of financial instrument that has several distinguishing characteristics that have been set forth by the FASB. So the following characteristics are that of a derivative. So it derives its value from changes in the rate or price of a related asset or liability, and the rate or price is known as an underlying. And the quantity or number of units specified by a derivative is going to be known as the notional amount. It also requires little or no initial investment upon inception, and it also allows for net settlement, and that the derivative contract can be settled in exchange for cash without having to actually buy or sell the related asset or liability. So it's important to note that the underlying is not the asset or liability itself, but rather its price or rate. Very important. The underlying is not the asset itself. It's just specifically the assets, the price or rate of that asset. Both the underlying price or rate and the notional amount are going to be necessary in order to determine the total value of a derivative at any point in time. So what are some common types of derivatives? The number of financial instruments that have the characteristics of a derivative has continued to expand, and in turn, these instruments have become increasingly complex. Within the context of hedging the risk associated with foreign currency exchange rate risk, two common types of derivatives are forward contracts and options. So a foreign currency forward contract. A foreign currency forward contract is an executory contract to buy or sell a specified amount of foreign currency at a specified fixed rate with delivery at a specified future point in time. The party that agrees to sell the asset is said to be in the short position, and the party that agrees to buy the asset is said to be in a long position. The specified fixed rate in the contract is known as the forward rate. The specified future date is referred to as the forward date. Now, the value of a forward contract is zero at inception and typically does not require an initial cash outlay. Now, the total change in the value of a forward contract is measured as the difference between the forward rate and the spot rate at the forward date. Okay, so for example, let's assume on April 1, a party called the writer writes a contract in which he or she agrees to sell to another party. And this other party agrees to buy a million foreign currencies at a specific price of 16 cents per foreign currency. Delivery is going to be in 90 days on June 29th. So the relationship between the parties is shown right here. So we have the writer of the contract is going to convey a million foreign currencies in 90 days. So the holder of the contract is going to pay $160,000 in 90 days. So the $160,000 comes from, we can see here at the bottom, the million foreign currencies at the forward rate in 90 days of 0.16. That's $160,000. Now, if the spot rate at the end of the forward period is going to be 18 cents, then the total change in value is going to be determined as this right here. We have a million foreign currencies at the spot rate of 18. 0.18 is going to be 180,000, so that's going to be a gain in value to the holder of $20,000. Now, why is this a gain as opposed to a loss? This is a gain because on June 29th, the holder received something with a fair value greater than the fair value given up that day. So conversely, this would be a loss to the writer. The holder of the forward contract could buy foreign currencies for $160,000 on the forward date compared to the spot value of $180,000 at that time and immediately experience a gain of $20,000. So when the value of a derivative can change in both directions, a gain or loss, it is said to have a symmetric return profile. So measuring changes in the value of a forward contract over time. So the cumulative change in the forward value of a contract is measured as the difference between the original forward value and the remaining forward value. So because the forward rates represent values in the future, the contract value, or the current value, is represented by the present value of the future rates. So let's take another example, look at another example here. Assuming a 6% discount rate, the change in value of the forward contract over time is as follows. So total forward value, if you recall, this is the exact same example that we had in the derivatives module, but we'll still go over it one more time. So how do we get the total forward value? If we recall, 90 days out from the contract date, it was 0.16 times a million foreign currencies, which would be $160,000. So 60 days remaining, we're at 0.17 at a million foreign currencies, which would be 170,000. So the cumulative change in the forward value from 160 to 170 is 10,000. At 30 days, it's still, the forward rate is still at 0.17 with the notional amount of a million foreign currencies, so that's still 170. So once again, the cumulative change in forward value is still only 10,000 since the inception is 160 to 170, so that's still 10,000. And at 0 days out at maturity, the forward rate is going to be 0.18. Applied with the notional amount of a million, which will give us the $180,000. So the cumulative change in forward value since the inception of the contract, in this case, is going to be $20,000, as we see here. So that's how we go about the total forward value and the cumulative change in forward value. So now what about the present value of cumulative change? So we can see down here, the present value calculations based on 6% per annum would be half a percent per month. So 6% divided by 12 is going to give us a 0.5%. So that'll be applied per month. So at 60 days out, we have $10,000 divided by 1.005 to the second, which gives us 9,901. So the current period gain in this period is going to be 9,901, because we can see here the previously recognized gain or loss was immeasurable because it wasn't there because it was the inception of the contract. So therefore, this whole entire present value of cumulative change is going to be the current period gain. So for 30 days out, we have 10,000 divided by 1.005, and that's going to leave us with 9,950. So that's the present value and the cumulative change at this point in time, less the previous gain or loss would be the 9,901 from right here. So this current period gain or loss is only going to be $49. Now when there's 0 days out, no need to do the present value because we already know what it is. It's $20,000. And obviously we have $9,950 of a previously recognized gain, and we get the 9,950 from the 9,901 plus the 49 gives us 9,950. So if we take that away from 20,000, it leaves us $10,050, and that will be the current period gain when there is 0 days out to maturity. So note that the total change in the value of the forward contract is $20,000. And we can see this because the 9,901 plus the 49 plus the 10,050 gives us $20,000. So that's how it's recognized over time. You have to find the present value of the cumulative change in forward value, and then take away what the previous gain or loss is from that point, and that gives you your current change or current period's gain or loss. And obviously it's cumulative over the time, it's spread out so that the end it should equal the total gain, in this case $20,000. So some special hedging complications. Forward contract expires before settlement date. Roll over the forward contract, then purchase the necessary foreign currency to satisfy the contract, and acquire a new forward contract to sell the foreign currency when the customer pays. Then we're going to purchase the necessary foreign currency to satisfy the contract and deal with the foreign currency when it is received. So what about the forward contract expiring after settlement date? In this case, we're going to hold the foreign currency until the date of the original forward contract, roll the contract back and sell the foreign currency immediately, sell the foreign currency immediately and sell the forward contract to another party, and then sell the foreign currency immediately and acquire the foreign currency at the spot rate when the forward contract is settled. Now, what about the forward contract amount being different than the transaction amount? If it is less than the transaction amount, then we have a partial hedge. If it's greater than the transaction amount, then we have a speculative hedge accounted for as an investment. So just as a heads up, I'm not going to be really focusing on the exam on anything for these last three slides, the special hedging complications, in terms of it expiring prior to the contract, after the contract, or it's different from the transaction amount. I just wanted to cover it so that you have a general idea about some of the special hedging complications. So once again, don't really focus too much time if you're stumbling on it. Don't really focus too much of your time and effort on it, as you won't be seeing anything like that on the exam. So foreign currency options. What is a foreign currency option? Once again, a foreign currency option represents a right rather than an obligation to either buy or sell some quantity of a particular foreign currency. Now, the option is going to be valid for a specified period of time and calls for a specified buy or sell rate or price. This is going to be referred to as the strike price or exercise price. Now, if an option allows the holder to buy an underlying, it's going to be referred to as a call option. If an option that allows the holder to sell an underlying, it's going to be referred to a put option. Now, option contracts are going to require the holder to make an initial non-refundable cash outlay, which is going to be known as a premium. And this is going to be represented by the option's current value. The premium is paid in part because the writer of the option takes more risk than the holder of the option. The holder can allow the option to expire, while the writer must comply if the holder chooses to exercise it. So the following terms are used to describe the relationship between the strike price and the current price. It's good to note that the premium is not considered in these relationships in this chart. So we have the two types of options. We have the call and the put. So let's start with the call option here. If the strike price is equal to the current price, we're at the money. If the strike price is greater than the current price, we're out of the money, because if we have a right to buy an option and the strike price is higher than the current price, obviously we're out of the money because we'd be paying more than we would without exercising the option. If the strike price is less than the current price, then we're in the money, because then we could buy the current option or whatever it is we're looking at, and buy it at a price less than what the actual current price is, and then sell it for what the current price is and make an immediate gain. So therefore it'd be in the money. Now, in terms of a put option, if the strike price is equal to the current price, then we're at the money. If the strike price is greater than the current price, then we're in the money, because then we would have the right to be able to sell something for a higher price than what the current market price is, so we would have an immediate gain. Now, obviously, if the strike price is less than the current price, then we'd be out of the money with a put option, because we would only be able to sell it for a less price than what it's currently trading for on an active market. So that's just a good little chart there to see the relationships between the strike price and the current price in terms of a call and a put option. And obviously, the value of the option is going to consist of the intrinsic value and the time value. So the time value and intrinsic value is going to determine the value of the option. So the intrinsic value is going to be the difference between the strike and spot prices, and the time value is going to be the difference between the current value and intrinsic value. So once again, the opportunities for gains and losses in terms of the holder and the writer. So the potential for a gain for the holder of an option is unlimited, and the potential for a loss for the holder of an option is limited to the amount of the premium paid. Obviously, because if it's out of the money, they're not going to exercise the option. They'll let it expire. The premium is non-refundable, so that's their maximum loss. But the gain's unlimited depending on the volatility of whatever the underlying is. Now, the potential for gain on the writer of the option is limited to the amount of the premium. The potential for the loss on the writer of an option is unlimited. Once again, that's tied or has a direct relation or correlation to the volatility of the underlying. So because the counterparties do not have equal opportunity for both upside and downside changes in value, options are said to have an asymmetric or one-sided return profile. And once again, as we said before, the difference between the strike and spot prices at any point in time measures the intrinsic value of the option. So changes in spot prices will change the intrinsic value of the option. Now, changes in the length of the remaining forward period will affect the time value of the option. So the time value is measured as the difference between an option's current value and its intrinsic value. So to illustrate the value components of an option, assume that a put option, which is the right to sell, allows for the sale of 100,000 foreign currencies in 60 days at a strike or exercise price of 50 cents per foreign currency. The value of the option would consist of the following. So let's just look here. So the put option to sell 100,000 foreign currencies in 60 days at a strike price of 50 per foreign currency. So let's see here. Value of 100,000 foreign currency at a current spot rate is going to be, let's assume that on the initial date of purchase is going to be 51,000. Assumed total value of the option is going to be $1,300. The intrinsic value is nothing right here because the option is out of the money, because it's 51,000 as opposed to 50, because we have 50 foreign currencies at 100,000, which will give us 50,000. So obviously, it's a put option right to sell. If we just went over the chart back here, if it's the put option right to sell, the strike is greater than current. It's our strike is less than current. It's out of the money. So it's out of the money. So the time value on this case is going to be $1,300. So it's going to be the total value of the option, if you remember, less the intrinsic value. In this case, there was no intrinsic value, so the time value is going to be the same as the total value of the option at the initial date of purchase. Now, at the end of 30 days, the value of 100,000 foreign currency at the current spot rate is going to be 49,000. So assumed total value of the option is $1,650. In this case, the intrinsic value is 1,000, 50,000 versus 49,000, so we're in the money here. So the total value of the option, once again, is assumed to be $1,650. The intrinsic value is 1,000, so therefore the time value is going to be $650. So once again, it's the total value less the intrinsic value. In this case, the total value was $1,650 less the intrinsic value of 1,000 leaves the time value of $650. So what about at the end of 60 days? The value of the 100,000 foreign currency at the current spot rate is going to be $48,000. The assumed total value of the option in this case is $2,000. And obviously the intrinsic value in this one is going to be $2,000 because we're in the money, $50,000 versus $48,000. In this case, the time value is going to be nothing. Obviously, because the total value less the intrinsic value leaves us with nothing. And also, you know this because the time value, it's expired. It's at the end of the 60 days. So it should be that. So hopefully this little chart right here gives a good little explanation. So once again, please study this. If it does not make sense, please let me know, and we will go over it together. You can come by my office, whatever needs to be done to make sure you get it. But I think it's pretty self-explanatory if you just take the time to look at it and see it. This really breaks down your difference between what the total value is, the intrinsic value, and the time value, and how we go about finding each of these relative values. So accounting for derivatives that are designated as a hedge. If an item is denominated in a foreign currency, it is exposed to risk associated with changes in exchange rates. Now, the risk may be traceable to a number of situations, including a recognized asset or liability, a forecasted transaction, or a firm commitment. Now, this exposure can be hedged through the use of a fair value hedge or a cash flow hedge. Now, a fair value hedge is used to offset changes in the fair value of items with fixed exchange prices or rates. Fair value hedges include hedges against the change in the fair value of a recognized foreign currency denominated asset or liability, an unrecognized foreign currency firm commitment. Now, a cash flow hedge is used to establish fixed prices or rates when a future cash flow could vary due to changes in prices or rates. Cash flow hedges include hedges against the change in cash flows associated with a forecasted foreign currency transaction, the forecasted functional currency equivalent cash flows associated with a recognized asset or liability, and an unrecognized foreign currency firm commitment. So, special accounting for fair value hedges. The hedged item in a fair value hedge is either a recognized asset or liability or a firm commitment. So many accounting principles do not allow for the recognition in current earnings of both increases and decreases in the value of recognized assets, liabilities, or firm commitments. However, if the risk of such changes in value is covered by a fair value hedge, special accounting treatment is allowed that's going to ultimately provide for the recognition of such changes in earnings. In a qualifying fair value hedge, the gain or loss on the derivative hedging instrument and the offsetting loss or gain on the hedged item are going to both be recognized currently in earnings. Now, in order to qualify for special fair value hedge accounting, the derivative hedging instrument and the hedged item must satisfy a number of criteria. A critical criteria is that an entity must have a formal documentation of the hedged relationship and the entity's risk management objective and strategy. The entity must indicate the reason for undertaking the designated hedge, identifying the hedged item and the derivative hedged instrument, and explaining the nature of the risk being hedged. This criteria must be satisfied at the inception and cannot be retroactively applied after an entity has determined whether the hedging would be appropriate or not. Another important criteria is that the hedging relationship must be assessed both at inception and an ongoing basis to determine if it's highly effective in offsetting the identified risk. Now, special accounting for cash flow hedges. A non-derivative financial instrument may not be used as the hedging instrument in a foreign currency cash flow hedge. Furthermore, as is the case with a fair value hedge, special hedge accounting is not available for cash flow hedges unless a number of criteria are satisfied. Cash flow hedges must also meet the criteria regarding documentation and assessment of effectiveness, just as the special accounting for fair value hedges, the criteria that related for that. So if the derivative instrument and the hedged item satisfy the criteria, then the cash flow hedge will qualify for special accounting. Now, the effective portion of the gain or loss on the derivative instrument will be reported in other comprehensive income, which is a separate component of shareholders' equity. As with fair value hedges, a portion of the derivative instrument's gain or loss may be excluded from the assessment of effectiveness. Now, that portion of the gain or loss will be recognized currently in earnings rather than as a component of other comprehensive income. The amounts reported in OCI will be reclassified into recognized earnings in the same period in which the hedged item affects earnings. So, for example, Assume that a forecasted sale of inventory is hedged. Once the inventory is sold and recognized in earnings, the applicable amount, the OCI gain or loss, will also be recognized in current earnings. Now, if the forecasted transaction were a purchase of a depreciable asset, the applicable portion of the OCI would be recognized in earnings when the asset's depreciation expense is recognized. And moving forward with the rest of this is going to be just a summary of the hedging transactions between the transaction being forecasted, commit to the transaction, or the transaction occurring. It'll give you the type of the hedge, the basic purpose of the hedge, the measurement of the value of a forward contract at a point in time, measurement of the value of an option at a point in time, the recognition over time of changes in the value of the derivative, the measurement of the time value of a derivative at inception, the portion of the time value of a derivative that is excluded from the assessment of the hedge effectiveness. If excluded from the assessment of a hedge effectiveness, recognition of the change in time value, the recognition of the gain or loss on the hedged item, the measurement of the gain or loss on the hedged item, and the effect of the basis of the resulting transaction. So once again, these last three slides are just going to explain the summary of the hedging transactions for the three different types of transaction, whether the transaction's forecasted, committed, or it occurs, and the different attributes that are being assessed here. So I'm not going to go over and just read through all these verbatim. This is something you can do on your own time. This is all that I have for you as far as content for Chapter 10 goes. Like I said before, there is a lot of overlapping content from that of the derivatives module, so a lot of this should be a review if you've already looked at that module, which hopefully you have. So this, in a lot of sense, is just a review. So if everyone would please read Chapter 10, it would help a lot. And for some good practice other than that of the homework, if you look at page 564 from page 564 throughout the remainder of the chapter, it gives some great examples of the accounting for fair value hedges, which is the sixth learning objective, which I am not going to go over all these examples in class. I think it would be more beneficial for you all to read these on your own time. What I will be going over will be the homework that is assigned for Chapter 10, which will be assigned tomorrow. Once again, I apologize for not getting that homework posted this evening before class. As I said before, I was getting midterms averaged as they're due today. So once again, please read Chapter 10. Be on the lookout for Chapter 10 homework being posted tomorrow. Chapters 10 homework will be due at 11:55 p.m. next Monday. We will review those homework answers before the homework assignment is actually due, so you have that access to that material. Please do attempt these assignments prior to seeing the answers. And also, in regards to Chapter 9 and derivatives module homework, once again, I will be posting the solutions to those problems. I'm sorry, my head went blank. I will be posting the solutions to those problems this evening. So be on the lookout for those as well. Once again, that's all I have for Chapter 10. Hope everyone is doing all right and is understanding everything we've covered. If not, please email me or please come and see me in my office hours. They're Monday, Wednesday, and Friday from 9 to 12. I will be there. So hopefully everyone's going good with everything, and everyone have a nice week, and I will see everyone on Monday.